Today I would like to analyze Snap Inc., also known as Snapchat. So the function of Snapchat is you can create pictures and videos, share it with other users, or share it in your own story. You can also use the calling option, which you can do audio and video calls. You can share your location, and you also can use the stickers. So I think it has similarities to TikTok because you can watch a lot of short videos there. And if we take a look at the stock price, we can see in 6 months it decreased around 24%. So we already have a recovery in 1 month. We can see we are up close to 40%. If we take a look at the 1-year charts, we are still down 24%. And the 5-year charts, we are also down 20%. And if we take a look at the high in 2021, it looks even worse with around 84% down. So it's an interesting company and we're gonna take a closer look at the financial. So the first thing we can recognize about Snapchat is a market cap of 20.81 billion US dollar. So it's not a small company anymore in my opinion. But if we compare it to their competition, for example, Alphabet, also known as Google, it has a market cap of 2,270 billion, and Meta, also known as Facebook, has a market cap of 1,560 billion US dollar. So comparing to these companies, Snapchat is still very small, and it could mean this has a more potential to grow in the future. So the market cap is the current stock price multiplied with the total number of outstanding shares. So this is a good indication how much the company is valued. Now we're going to take a look at the financial foundation for unprofitable companies. The first thing we are looking for is revenue growth over the last 5 years. So we can see here Snapchat had a revenue growth of 46% in 2020. In 2021, it was around 64%, 2022 around 11%, and in 2023 around 0%. So we have a good growth over some years, but now the growth is slowing down, so we don't like to see that, but it's still a check here. The next thing we are looking for is the net income improve over the last 5 years. So we can see here in 2019, it was around 1 billion in the negative. Then we have an improvement in 2020. We have 944 million in the negative. 2021, we have an improvement again with 487 million in the negative. And then we have in 2022 a worsening again with 1.4 trillion billion in the negative. In 2023, we have a slight improvement, but it's still $1.32 billion in the negative. So we don't really like to see that. We had a small improvement for some years, but then we have a worsening again. So it's not a check here. So now we would like to see the free cash flow improvement over the last 5 years. We can see here in 2019, it was negative around 341 million US dollar. In 2020, we have the improvement. It was 225 million in the negative. And in 2021, we became positive free cash flow with 223 million. Then in 2022, we have a decline of the free cash flow with 55 million US dollar. In 2023, we have a decline again with 34 million US dollar. So at the end, it's an improvement. We become positive free cash flow, but we have a decline for some years now, so we don't really like to see that. I will give a check here anyway. So the main question we should asking right now is, why is the net income negative in the last 5 years, as we can see here? And why is the free cash flow positive 3 years in a row, as we can see here? So the main reason for this is the stock-based compensation. So what they're doing is they issue new shares. They increase the shares outstanding and they pay the employee with shares. So this is part of the salary. So why it's not showing in the free cash flow? Because in the free cash flow, it only shows the money that comes in and the money that goes out. So that's why it's showing in the net income and not in the free cash flow. So I think they pay a lot of salary with shares. And what does this mean for the investor? So actually it means the shares that they own decrease in some way, because the shares outstanding increase and you only have the same shares, right? You have one share maybe or two shares, and they increase the shares outstanding. So you still have two shares, but now the cake just got bigger and your part is still the same. So it's not really good for the investor. It's only good if the company is really growing their revenue and really has a reason to do that. So we like to see the company investing in their own business, growing their business. So then it makes sense. But if they have such a high stock-based compensation, we not really like to see that for no reason. So the next thing we are looking for is cash on hand, at least 10% of the market cap. So what is cash on hand? So it means the money they have in the bank that they can use for investing in their business or buying something, doing acquisition. So it's a very important number. So we can see here, Snapchat has 3.54 billion. So we write it down here. And then we have a market cap of 20.81 billion. So we want 10% of this as a cash on hand. So it's not a difficult calculation. We just get 10% of this. So this is around 2 billion, roundabout. So now we can see here they have enough cash on hand. They have way more than we expect them. So this is quite a good number. We can do a check here. So the next thing we are looking for is debt. We don't want the debt to be too much. So debt should be under 30% of the market cap. So now what we're going to do is we're going to take a look at the debt. For me, it's important taking the long-term debt and the short-term debt. So we can see here the short-term debt is around 50 million and the long-term debt is around 4.3 billion. So let's say around about 4.35 billion, right? Here's also billion cash on hand. So now we want it to be under 30% of the market cap. So we're going to take the market cap 20.81 billion and then we're going to divide multiply it with 0.3 and then we have the 30%. So how much is this? 1 second. Okay, we can see is 6.24 billion. So the debt should be under this number, and as we can see here, it's under the number. So it's a check as well, but it's still risky. So they still have a lot of debt. The good thing is they have a lot of cash on hand as well, but they still have more debt. We should keep this in mind too. It's not the best number. So some companies, they have better numbers as well. So I would like to give my conclusion about this company. So let's start with the positive things. They have a good revenue growth for some years, especially in 2020 with 46% and in 2021 with 64%, which is very good. We also have to mention now that the revenue growth is not good as before. So now the revenue grow in 2023 around 0.09%, which is not great. The next thing would be positive free cash flow. So we had 3 years in a row positive free cash flow, which is a good thing. So we also need to mention now that the free cash flow is declining. So it's not increasing anymore right now. So we don't really like to see that as well. The next thing would be cash on hand. So we have a good amount cash on hand with 3.54 billion US dollar. This is a good number. They can invest this in the business and I like to see that. So now the negative things would be, we have a negative net income. Like 5 years in a row, we have a negative net income. The reason is a high stock-based compensation. So I already mentioned it, but this is the main reason. I also write it down here as a negative thing. And the negative thing would be also the shares outstanding increase. So I can show it here as well. We have a shares outstanding increase for the most years. Only in 2022 it decreased, but other years it increased, sometimes over 6%, which is a lot in my eyes. So I don't really like to see that. And the reason for that is the high stock-based compensation. Yeah, so it's not really looking great about this. And they also have a lot of debt. 4.35 billion debt is not less in my eyes. So this company has some positive things with the revenue growth, but is slowing down, and a lot of negative things in my eyes. So personally, I would not recommend investing in this company, but I also understand that this company has a lot of opportunities. So if they can make more money with the ad revenue or increase something about their business, this company also can increase a lot in the stock price. So they need to have a good management, but it definitely has potential as well. I don't see this company only negative. I think this company has a potential and also positive things, but a lot of risk as well. So I'm not really recommending investing in this company, but you need to make your own decision about that.